We're at the GAIM Hedge Fund Conference in Boca Raton, Florida, speaking with various hedge fund managers. Joining me now is Andrew Jackson, Chief Investment Officer of Cairn Capital. Good to see you here.
Good to see you too.
Now, your specialty is European credit. You've got about $16 billion in assets under management. Where are we now in terms of the broad picture, given all that's happened in Europe in the past year?
That's a fascinating question. It's a very difficult one to call because I think it needs to be seen within a global context. We've spent the whole of 2012 focusing on Europe and the problems that Europe's having. As we ended 2012, we focused on your side of the world and we looked at the fiscal cliff. And I think now as we look forward, it's difficult to see past what Mr. Draghi has done and the intervention that he's taken. It's difficult to see past that reduction in systemic risk that we've seen in Europe. And therefore, I think there is a period of relatively low volatility. We're already in an incredibly low volatility environment. But looking forward over 2013, I think there's a real possibility that we see low vol in Europe, and the opportunity is there to recycle risk and make very real returns from credit and credit markets in Europe. One thing that could potentially destabilize that, and the first thing that we're really looking at, is the Italian elections.
Yep.
Obviously, there were rumours back end of last year about Mr. Monti not wanting to go again. If he goes again, I think we're set for a period of relative stability. Even more stability can come, I think, if Spain actually takes the plunge and comes and asks for money. Bizarrely, I think that's a positive for markets.
Why?
Because I think at the moment there's still some uncertainty about Spain having bravado and saying we won't go for the money, we won't ask for the money. And once you get to that tipping point, the market will start to get very excited again about the possibility that Spain is going to tip over and that unemployment is going to creep up. But I think if Spain comes to the OMT now, I think that they can come at a level where it looks like they're coming with strength. Spanish yields are very, very low, so it's not like they need it. And I think it's a strong signal. It's a strong signal about Europe and Europe's future. Monsieur Hollande said this morning, I don't know whether you saw, Monsieur Hollande said that the worst is behind us in Europe. I'm not sure whether he meant it or he's just saying it in order to continue to make us feel positive.
But if you see less volatility, explain to me how then that provides better returns, because don't you guys thrive on volatility? I mean, that's one way you generate the returns, is to play off some of that. Yeah,
I personally love volatility. My favorite times in the office are when the market's going crazy. It's an environment that I thrive on personally, but I don't think that's the only market in which you can make money. We make money, our job is to make money and not lose money. We make money in markets where the beta is positive within the strategies that we select, but we can also make money from alpha. And I think as we enter 2013, this is a real alpha-rich environment. As I said in the last panel, when volatility falls, correlation normally falls with it. And if you look at the pairwise correlation between stocks in Europe, pairwise correlation between credits in Europe, that's really, really declining very rapidly, which means that idiosyncratic risk is a real driver behind returns. So you can pick a short that you really like and a long that you really like and make money whether the market tanks or rallies.
You mentioned that you were focusing on our side of the pond at the end of last year with the fiscal cliff. There's been some talk about the U.S. being in a bond bubble. Do you think we are? And if so, how are you positioning yourself?
Yeah, it's very difficult to say whether we are or not, but given that you asked the question, I have to form a view. Thinking back a year ago, 12 months ago, Bill Gross, who's, bless him, actually goes out there and makes definitive statements. His big call for 2012 was to be short the Bund. I think there are a lot of people out there saying be short treasuries. I think that's maybe a marginally over-optimistic view that it's going to play out really, really rapidly. I think 3 years from now, people will look back at these rates and they'll say they were crazy. But for now, and the next 6 months, I think the trend is your friend, and I think we're going to stay constrained. So I don't think you're going to make a lot of money by being short the long end. I don't think you're going to make any money from being short the short end, but short the long end, I don't think is going to deliver you significant returns. That having been said, your second part of your question was about hedging. And I think that now we need to look for elegant ways to hedge the fact that we get a steepening in rates curves and a further steepening in credit curves. The way in which we're doing that is looking outside of our normal environment, because actually volatility is relatively expensive in credit and relatively cheap in other markets. So we're looking at things like VIX, we're looking at puts on the S&P, We're looking at puts on the CAC 40, which is way outside our normal range, but they are interesting ways for us to put on hedges that something could go wrong that we can't predict.
And in terms of where you're looking positive, where you're looking in long strategies?
Yeah, for me, that's a relatively easy question to answer compared to your last one. You've got to look for opportunities where you feel like even if things go badly wrong, you're still going to make decent money. And that's about price appreciation, but also about yield. So if I focus back on Europe, I think subordinated financial debt is still a very interesting asset class, mostly because it's a shrinking underlying asset class as we see the emergence of CoCos and ECNs, these new hybrid capital instruments issued by banks in Europe predominantly. The shrinking asset class is one argument. The other argument is that people don't understand these assets particularly well. They're relatively complex instruments, even within the credit world, and they're also the kind of instruments that swing very, very rapidly in price as people's sentiment about France or Spain or Italy changes. So I think there are opportunities there. There are opportunities within European structured credit. The US ABS market has been on fire in 2012, and I think that it's very difficult for investors who've got hooked on mortgage yields in the US to get their mind onto something else. So they're going to look across the pond. I think they're going to look at European opportunities, and I think we've got some serious upside there.
All right, Andrew Jackson of Cairn Capital, great talking to you.
Thank you very much.
Thanks so much. I'm Rhonda Schaffler. This is Reuters.